Hello, and welcome to Business Policy Roundtable, the show where we break down the laws, regulations, and government decisions shaping how business gets done across Africa. Every week, we take a closer look at policies, what they really mean, who they affect, and how they impact entrepreneurs, investors, and everyday people trying to build and grow. From tax reforms, shifts in finance, technology, and energy, to trade policies and central bank moves, we connect the dots. I'm Sarah, and together we'll make sense of the policies driving Africa's business landscape. This week on Regulatory Eye, Ghana to mandate all businesses to use .gh domains. Ghana's Cybersecurity Authority proposes changes to the 2020 Cybersecurity Act. Nigeria moves to create a single regulator for fintechs. The government of Ghana has introduced a draft bill called the Ghana Domain Name Registry Act 2025, which would require all legally registered businesses operating in Ghana to use the .gh country domain extension for their official websites and digital platforms. The Act says that any entity legally registered or operating in the Republic must register and maintain an active .gh domain name for any official website or digital platform intended for public access. It creates a new body, the Ghana Domain Name Registry, which would administer the .gh domain space, keep a central registry, and offer secure email services for government bodies. The Act also offers a transition period of 6 months for organizations not currently on .gh to make the switch once the law takes effect or risk sanctions. However, businesses that do not target Ghanaian users and digital platforms hosted outside the country can apply for an official exemption. The Act also sets out penalties for non-compliance, including fines, license suspension, or revocation. The registry may even ask the High Court to block or deactivate domain names or compel ISPs to disconnect defaulting entities. Now, why does this matter? On one level, it seems pretty straightforward. Standardizing domain usage can help strengthen national digital identity, ensure that entities operating in Ghana are visible under the Ghana brand, perhaps improve trust and security. But on the other hand, especially for businesses and digital platforms, this move raises some interesting questions. For businesses, if you're operating in Ghana, but you've built your brand on, say, a .com or a .io or some other domain, you now face a switch costs. That means rebranding, updating digital assets, ensuring SEO continuity, redirecting traffic, notifying users. Moreover, the 6-month transition period sounds tight infrastructure-wise. Domains, hosting, email migration, and security updates take time. If many businesses are told to switch, there might be operational glitches, downtime risk, or unintended consequences. The Act comes alongside other bills in Ghana, such as the amendment to the Cybersecurity Act and the Data Harmonization Bill. So, you could interpret this domain move as part of a broader shift, where Ghana is asserting greater control and visibility over its digital ecosystem. Speaking of the Cybersecurity Act, Ghana is looking to significantly upgrade its cybersecurity laws. Under the current Act, the Cybersecurity Authority has certain responsibilities, but the proposed amendment introduces much broader powers, including things like arrests, search, seizure, asset recovery, licensing and accreditation of cyber professionals, and regulation of critical information infrastructure. The amendment would give the Director General, Deputy Director General, and authorized officers the powers of a police officer. They'd have powers of arrest, search, and seizure for cyber offenses under the law. The bill also expands what counts as critical information infrastructure, like system-side defense, finance, utilities, emergency services, digital platforms, and more. The minister would have discretion to designate them and set roles. On the funding side, the amendment proposes that the Cybersecurity Authority receives a share of fines, fees from licensed entities, and portions of corporate tax and communication service taxes. That means the regulator is getting stronger financial backing. It also creates stricter licensing and accreditation for cybersecurity professionals and service providers. If you're offering cyber services or consulting in Ghana, you'll likely need accreditation or a license under this amendment. This amendment isn't just about cyber threats in the abstract. It has practical implications for how businesses operate in Ghana's digital ecosystem. Businesses that operate a digital service or platform, or companies that work with data, will likely be affected by the stricter rules around infrastructure, accreditation, and registration of systems. That means extra compliance costs and legal risk. If you're working in emerging tech like AI or blockchain, you need to keep an eye on how Ghana defines those in law. The amendment says the Cybersecurity Authority will set standards for these innovative products. That could be a compliance hurdle or barrier to entry. But there are concerns. Some observers are worried about overreach. When a regulator gets police-type powers, how will that affect business freedom, innovation, or data rights? Ghana's tech ecosystem still needs a balance between regulation and growth, or risk dampening the very innovation it wants to promote.
The second order of the day is commencement of debate on the general principles of a bill for an act to provide for the establishment of Nigerian Fintech Regulatory Commission in Nigeria and for related matters. Standing in the name of Honorable Fuad Kayode Laguda.
Now to Nigeria, where a proposed bill to create a single regulator for all fintech activities has just been approved for a second reading by the House of Representatives. The Nigeria Fintech Regulatory Commission bill, sponsored in Nigeria's House of Representatives by Honorable Fuad Kayode Laguda, would establish a central regulatory body to license, supervise, and regulate fintech firms, essentially replacing or absorbing the responsibilities of multiple existing regulators like the Central Bank of Nigeria, the Securities and Exchange Commission, the National Information Technology Development Agency, and the Nigeria Deposit Insurance Corporation. Under the bill, fintech companies would need either individual licenses or class licenses, depending on whether they're doing payments, lending, crypto, crowdfunding, or regulation tech activity. The Regulatory Commission would set performance standards, consumer protection codes, data use standards, dispute resolution processes, and service quality benchmarks for fintechs. The regulator would also have power to conduct public and private inquiries, compel information disclosures, and publish compliance findings. Non-compliance can lead to license suspension, revocation, or heavy fines. Now, what does this mean for fintechs? For fintech startups, on the positive side, one regulator could simplify compliance. Rather than juggling multiple agencies with overlapping mandates, there could be a one-stop shop that could reduce uncertainty. On the less positive side, the regulatory burden may go up. New licensing, ongoing audits, higher compliance costs, and for early-stage startups, this could mean budgeting legal and compliance earlier than planned. For the market overall, this move signals that Nigeria wants to be serious about regulating fintech, not just as an emerging sector, but as a strategic part of its financial ecosystem. It could boost investor confidence if done well, because regulation clarity often reduces risk. But if it's heavy-handed or poorly implemented, it could stifle innovation, increase entry barriers, or slow rollout of new services. To help us unpack this even further, we'll be joined by Chimgoziru Mokoma, one of our senior reporters here at TechPoint Africa. Tune in at 2 p.m. to listen to his insights on Stakeholder Brief.